What is APR for immigrant small business loans? Imagine starting a small business and wondering how much it will truly cost to borrow money. That's where the term annual percentage rate, or APR, comes into play. It shows the real yearly cost of a loan, including interest and all fees. For immigrant entrepreneurs, understanding APR helps compare different loan options and manage costs better. When looking at government-backed loans like those from the Small Business Administration, the interest rates are often more affordable. These loans are popular because they offer flexible terms and lower interest rates thanks to partial government guarantees. The most common SBA loan is the 7A loan. The interest rate for these loans is usually tied to the prime rate, which is the rate banks charge for short-term loans to big companies, plus a margin. For loans over $350,000, the maximum interest rate is the prime rate plus 3%. For smaller loans, the margin can be higher. These rates can stay fixed or change over time, depending on the loan agreement. Because APR includes fees like loan origination or closing costs, the actual yearly cost might be a little higher than just the interest rate. SBA loans can have terms up to 10 years for working capital needs, or up to 25 years for buying real estate or equipment. These longer terms help keep monthly payments manageable, which is helpful for new immigrant business owners trying to grow their assets. Microloans are another option, especially for smaller or newer businesses. These loans often come from nonprofit lenders or community development financial institutions. Their interest rates usually range from about 8% to 13%. Some of these lenders offer fixed rates as low as 3% to 8%, depending on the loan size and repayment period. Microloans are shorter term and easier to qualify for, making them a good choice for immigrant entrepreneurs who might not have a long credit history. Traditional banks and credit unions might offer loans with variable APRs, but they often have stricter rules for approval. These loans can have higher interest rates and may be harder for immigrant families to get approved for because of stricter credit checks and documentation requirements. That's why SBA loans and community lender options are often better choices. They tend to be more accessible and affordable. Knowing the APR helps families decide which loan is best for their business. A lower APR means less money paid over time, which is important when budgets are tight. Choosing loans with lower APRs and flexible repayment options can make it easier to grow a business steadily. Many lenders also offer support like business coaching, which can help immigrant entrepreneurs navigate the financial system more confidently. To sum up, APR includes the interest rate plus all fees, showing the true yearly cost of borrowing. SBA loans for immigrant small business owners usually have APRs tied to the prime rate plus 3 to 6.5%. Microloans and loans from community lenders often have fixed APRs between 3 and 13%, making them more affordable. Traditional bank loans might have higher APRs and tougher approval processes. Picking a loan with a lower APR and flexible terms can help immigrant families build their credit and assets while managing costs wisely. Understanding these details allows families to make smarter choices and keep their business dreams moving forward.